Okay, today we're going to be going over the calculation for standard deviation, expected return for overall portfolio, and the expected return of the equity fund. Once again, the beige is given to us, and the purple, gradually going into darker, is important and more important. So we are given a 12.6% risk premium, a standard deviation of 40%, a rate on T-bills, which is 6.40%, client's investment in your portfolio equity fund, 75,000, and client's investment in T-bill money market fund, risk-free, 75,000. Calculating for a total value, we'll start off by adding our two investments together. Then we're going to go down to calculate for the weight of the equity fund, which we do by taking our total value and taking our equity, our money that we put into our equity fund, and dividing it by our total value. Then we're going to do the same thing for our weight of T-bills. We're going to take our T-bill money and we're going to divide it by 150,000, which is our total value. Now going down below, getting into the more serious, important calculations. Expected return on equity fund. All we do here is we take our rate on T-bills, our 6.40%, and add our 12.6% risk premium, which gives us 19%. Now for expected return of overall portfolio, we're going to take our two weights, and you're going to multiply each one of those weights by two different variables. The first weight you're going to take is your weight of your equity fund, and you're going to multiply it by your expected return of equity fund. And then you're going to put those in parentheses, and you're going to add that to the weight of the T-bill times your rate on T-bills, which is 6.40%, which will give you 12.7%. Now, for our final calculation, for standard deviation, what we do is we take our weight of equity fund and we're going to multiply it by our standard deviation, which will give us 20%.